Hello and welcome to Swag Academy. In this video I will make an in-depth stock fundamental analysis of the company TAV Airports. Monish Pabrai has a good portion of his portfolio in this stock. In this video I will try to explain why. I will cover the business history, business model, growth, balance sheet, profitability, valuation, outlook, and finally the 3M analysis. So make sure to watch till the end of the video. TAV Airport was founded in 1997 by Mustafa Sani Sener. Its headquarters is in Turkey. The company has a 79 billion Turkish lira or 2.43 billion US dollar market cap. Its stock is trading around $25 at the time I'm making this video. TAV Airports Holding is a Turkish airport operation and services firm that is part of the group ADP. It is one of the world's largest airport operators, providing services to over 1 million flights and 150 million passengers every year. It is the leading airport operator in Turkey and also provides duty-free food and beverage, ground handling, IT and security services. TAV Airport revenue peaked in 2013, then declined the years afterward until it reached its lowest value in 2020, the pandemic. Since then the revenues are increasing. The revenues increased by 25% in 2023. The gross profit is the result of revenue minus the direct cost to create these revenues. The gross profit margin is the result of gross profit divided by the revenue. The gray line in the chart represents the gross profit margin over the years. The gross profit margin was in a downward trend from 2014 till 2020. Then it started increasing in 2021-2022. As an investor, I like to see an increasing trend for the gross profit margin, which is not the case here. Now let's check the operating profit and the operating profit margin. Operating profit is the net income derived from a company's core operations. Put it another way, it is the amount of money that a company has left over after meeting its operating cost, but before paying its taxes. The operating profit was fluctuating between 2013 and 2017. Then it decreased dramatically in 2018, 19 and 20. Since then it has been increasing. The chart is all over the place, so it is not possible to determine if the company is growing or not. Time will tell. The same can be noticed with the free cash flow. The chart is all over the place. It is not possible to find a growing or shrinking trend. This is typical for such companies since they have a high capex and must continuously reinvest money in the company. Now let's have a quick look at TAV Airports' balance sheet. TAV Airports has 939 million euros in current assets. The current assets are the assets that are liquid and available to the company within 1 year. They include cash and short-term investments. The total current liabilities are the liabilities which the company must pay within 1 year. TAV Airport total current liabilities are 852 million euros. TAV Airport total liabilities, including long-term debt, are 3,323 million euros. By calculating the current assets minus the current liabilities, TAV is left with 87 million euros cash on its balance sheet, making the balance sheet strong and healthy. However, the company has 1,457 million euros long-term debt. Their free cash flow in 2020 was $159 million, so they need approximately 9 years of free cash flow to pay their debt, which is something I don't like to see as an investor. The company used to pay dividends in the past, however, since 2020 it stopped doing that and focused on repaying its debt. Now let's jump to valuations. TAV Airport has 1.59 price to sales ratio, an 8.29 PE ratio, a 12.5 price to free cash flow ratio, and 1.44 price to book ratio. Pause the video and check how the current ratios compare to previous years. Now let's do a discounted cash flow analysis to determine the fair price and intrinsic value of the stock. This is how my model works. I calculate the worst case scenario to determine the downsides, a normal case and best case scenario. The first column represents the growth rate for the next 5 years. The second column represents the growth rate for the 5 years afterward. The third column represents the terminal multiple or the PE multiple at which the stock will be sold in 10 years. The fourth column represents the discount rate or the rate of return the stock will grow over the years. Considering a 5% growth the first 5 years and a 3% the 5 years afterward, a terminal multiple of 8 and 15% discount rate, the intrinsic value of the stock is $3.88. TAV Airport is trading at $25, so it is clearly overvalued. Finally, the 3M analysis: 1M for moat, 1M for management, and 1M for margin of safety. TAV have a strong moat. It is running a monopoly and no new company can easily replace it. Furthermore, they own some airports and operate them, so it is a monopoly business. Management have done a good job running the business. They have made a lot of debt and investments. Time will tell if their choices were good or not. For the margin of safety, TAV is trading above intrinsic value. The balance sheet is okay and have some cash. TAV have a long-term debt to pay. In conclusion, I honestly cannot see the reason Monish Pabrai bought the stock. It is trading above intrinsic value. It is not a growing company and does not contain hidden assets that are valuable for a value investor. I will pass on this company and recommend that you do the same.